What is the difference between a first lien HELOC and a traditional 30-year mortgage?
Traditional mortgage is called a closed-ended loan, which means money can only flow in. So you can pay it down as much as you want, but everything is locked away.
If you're going to aggressively pay off your debt, doing it in a 30 or even a 15-year mortgage, like the way that Dave Ramsey recommends, like get a 15-year mortgage, so make the payment higher and then aggressively pay that off and just pray to God that you don't lose your job or get disabled. Oh, that's a terrible situation to be in. Whereas if someone aggressively pays off their mortgage with a first lien, if God forbid something happens, they have liquidity and control.
This is where we kind of start to better understand when it works and when it doesn't work, because it's not a fix-all for everybody. It actually doesn't work for most people. Kind of begs the question of who does it work for? On spreadsheets, on using math only, you could become debt-free faster. Yes, 100%.
Anthony Rushing has dedicated his career
to educating and empowering individuals
to take control of their finances
by strategically leveraging home equity.
The end goal is to help them develop financially so that they become essentially self-sufficient from a business and growth standpoint, where they're leveraging their HELOC to buy cash flow producing assets to help build businesses that are cash flowing to the point where if they wanted to become debt-free tomorrow, they could. First lien HELOC is called an open-ended loan, which means from a money flow standpoint, everything you put toward this to pay the balance down, you can also take back out if you want. If the goal is to create the lowest interest payment possible, then that means we need to just create the most number of days with the lowest balance. That's the big reveal.
Before we get into velocity banking, who it's for, who it's not for, the pros, the cons, I think you have a disclaimer. This lovely disclaimer that you have to say before we get into the fun stuff.
So I work for a bank called First Merchants Bank. I do not represent them. My opinions are my own. They are not representative of the bank. So, if I share things that are opinions, they're not the opinion of the bank. It's of my own. I'm an educator, so our conversation is for educational purposes. It's not financial advice.
Yes.
Disclaimer, right? So all those kind of things. But I want that to be clear, because when I could come out and do these things, it might be perceived that way. I just want to make sure that everyone knows and understands, like, this is Anthony, the person, not Anthony, representative of the bank.
Okay, so let's start from the basics. What is the difference between a first lien HELOC and a traditional 30-year mortgage? Like, talk about basic differences, even before we talk about like the concept of velocity banking and how people are using it.
So if we're comparing a first lien HELOC to a 30-year fixed rate mortgage, the way I like to think about it is they're both first lien position mortgages. Some people, claim a mortgage is defined as a death pledge. The way I like to think about it is a mortgage is just a loan that's secured by real estate. And so being in the first lien position means basically that if you default on the loan, the first position lien holder is the one that gets paid back first. And so a lot of times people like to see it as your initial loan that you get is in the first lien position. If you get another one, it's in the second lien position, kind of on top of the first.
Yes.
That's sort of how it's explained. So both are in the first lien position, but the way that they're different, the two main ways, one has to do with money flow and the other one has to do with how interest is calculated. So money flow wise, your traditional mortgage it's called a closed-ended loan, which means money can only flow in. So you can pay it down as much as you want, but everything is locked away. And so you're unable to take the money back out. It's just how they work. A first lien HELOC is called an open-ended loan, which means from a money flow standpoint, everything you put toward this to pay the balance down, you can also take back out if you want. Obviously, when you take it back out, it increases your balance.
Right.
But it allows for you to have the flexibility to put in as much as you want and take that back out as well. Second difference has to do with interest calculation. So the way that your amortized mortgage is going to calculate interest is it's going to look at the previous month's end balance, and it's going to look at the balance on that last day of the month and use that against your rate to calculate your payment. The way that the right or the type of first lien HELOC that I'm talking about today will calculate interest.
There's a couple different.
Here's the thing.
Is it like the life insurance space where there's 100 different ways?
Well, I used to say that all first lien HELOCs do it this way.
Okay.
And I was working for a bank at the point, and they said, well, actually, you can't say that because you don't know if they all do. And I said, that's a good point. So the kind of first lien HELOC that we're talking about here will calculate interest differently. It doesn't look at the previous month's end balance. It'll use what's called the average daily principal balance. So the way I like to think about it is you've got a bunch of days in the month, and each one of those days have individual balances. So if we've got a 30-day month, if we want to figure out the average balance for that month, is you take the average of all those individual balances, and that creates the average balance. So it uses that average balance of the month against the rate to calculate your payment. So main difference money flow wise is money can go in and out freely.
Right.
From an interest calculation standpoint, it calculates interest using the average balance instead of the previous month's end balance.
And do most first lien HELOCs have a variable adjustable interest, whereas most 15 or 30 years, it's common to have it fixed?
So from what I've seen, yeah. From my perspective, yes. There are ARM mortgages you can get, which are adjustable rate mortgages. A lot of times you'll lock it for 3 years, 5 years, 7 years, and then it'll go adjustable after that. There are first lien HELOCs that have periods of time where it'll lock the rate. Sometimes, at different points in time when the market dictates, you'll have players that enter and they'll come in with a 10-year lock period, that kind of thing.
Oh, so you've
I've seen
10 years locked.
I've seen 10 years locked
on first lien.
Yes, but not recently.
Okay.
So a lot of times when markets get extreme, you'll see banks make extreme decisions.
Yes.
With their products. So that was around for a little bit when rates started increasing drastically, but it's gone now. So I haven't seen it recently.
And right now we're recording this May 2026.
It's not available. That's not
how many years can you lock your interest rate for a first lien?
So the thing with first lien HELOCs is that usually they're held in-house, which means banks hold them on their balance sheet. So they have complete control over the guidelines in terms of the risk factors that they implement with it, as well as how they structure the rate. So some banks have a 2-year lock at a certain amount. There's a bank right now that has one for a 6-month lock or a 1-year lock. There's another entity that's planning on doing a 3-year or a 5-year lock. There was a point where we had a 3-year and a 5-year lock. And so in terms of what's available out there, it really is dependent on the banks that are offering at that point. And so it's tough to name a standard because there really isn't one.
I see. And then do most of them right now just change monthly, or could it change daily with the interest rate?
When they're variable?
Yeah. How often can the interest rates change?
So I've seen it as long as 6 months, and then down to a month.
Okay. And is it based on prime? Is it based on
Prime
plus?
It depends on the bank. So our bank uses the 1-month Treasury bill through the bond market. So that's the index that we use. The way that the rate with a variable rate product, the way that it's calculated is it initially looks at an index, and then it most likely adds a set margin on top of that index. So as the index fluctuates, it adds a set margin on top of that. So the prime plus 1 is a good example of index plus margin.
Yes.
Prime is just the most popular index that people refer to when referring to mortgages. And so there are bond indexes, there's a LIBOR, there's prime, multiple indexes. And so it just depends on which one the bank chooses to use as their base index. And so it's really dependent on the bank.
Cool. Okay. So if I had to summarize the difference between like a 30-year fixed mortgage versus a first lien, there's a couple differences. Number one is from a cash flow perspective, your money goes into the mortgage on a 30-year mortgage and it's not coming back out.
Correct.
Like you would either need to refinance or sell to get that money out.
Correct.
If there is built up equity. Whereas a first lien, it's how did you call it? It's a
open-ended.
Open-ended. So you can put money in and then have the option to be able to take that money out.
Correct.
Obviously, it's not free. It's going to include extra interest if you have a greater balance, but you have that flexibility. And then the other big difference is, I know you mentioned the interest rate. The big difference for me is the 15, 30-year fixed. There's a potential value of having it fixed versus the variable. Obviously, there's probably in history that the variable was very attractive, but with having variable, especially if it can change, it can also increase.
Yep.
And then the other thing is most banks are selling their 30-year notes.
Yep.
Because it's like no banks, especially with the low interest rates, would want to keep a 30-year mortgage on their books. And is it typical that most banks keep in-house first liens? Like, is that typical, or is that just your guys' bank? Like, how common is that?
With newer banks that enter the marketplace and are offering the product, yes. There are a few established mortgage groups that do sell their loans on the secondary market. And so the larger group right now, or one of the largest groups, they do happen to sell it to a third party.
Okay.
But when you see smaller, meaning not $200 billion, $500 billion banks, when you see smaller or mid-sized banks enter the marketplace with the product, usually they're keeping it on their balance sheet. It is a good balance sheet product. And a lot of times, it may take them some time to find secondary market, capital market buyers for the product. They're out there, they're growing,
right?
But it's not like you have a big Fannie Mae who's buying all First Lien HELOC.
Well, the reason it's a good, like, if I was an investor, I would much rather invest in a First Lien HELOC than a 30-year fixed, because you can change interest rates, and like it's still backed by real estate, and now 10%. The other big difference is in a 30-year mortgage, you could put 20% or more, but you can get it as low as 3.5%. Whereas with a traditional 30-year,
you have been. The funny thing is, because I'm in my bubble.
Yeah, it's you're not
I don't pay attention to amortized mortgages as much. You've been able to get 30-year fixed rate mortgages down to, I've seen them down to 1.9%. But
no, I'm not saying the percentage. I'm saying down payment.
How much you need
for the down payment.
Yeah, I misunderstood. So 3.5%, 3.5% down for an FHA loan. That does come with mortgage insurance for the life of the loan. So down payment, entry level from a barrier to entry standpoint, if it's a purchase contract, or if you are looking to refinance, strictly from a loan to value standpoint, the barrier to entry for a First Lien HELOC is going to be higher than that of a 30-year.
And then the First Lien is 10%.
10%. But it's funny because the context that I have from our bank, our bank is able to go to 89.9%. I'll say 90%, and then I'll correct myself. It's actually 89.9. I don't want you to call me on it, But so we can go to
11%.
We'll call 10.1%, right?
Yeah.
Down. But they're banks that their risk department, they don't like being able to go that high, so they'll cap it at 80%, 85%, those kind of things. So it really, it's the department, or the bank's philosophy on risk, and the factors that they really identify as being hot button issues from the board, but also the risk side of things. Like, they're the ones who end up driving a lot of the guidelines and what they're able to do. So
so before, again, we get into velocity banking and all the juicy questions and all, I want to establish the difference between First Lien and Second Lien, because there could be people that are watching this that are saying, hey, I have a HELOC, but this sounds a little different. Explain the difference between a Second Lien HELOC versus a First Lien HELOC.
My producer just told me something wild. Over 70% of you watching right now haven't subscribed to the channel. So whether you're brand new or one of our longtime viewers, if any of our videos have helped you see things differently or provided value to you in any way, I would love for you to subscribe, as we're trying to reach 100,000 subscribers by the end of 2026. We've got some incredible guests and conversations planned for 2026. I don't want you to miss them. I'm so grateful for each and every one of you who support this channel, and I'm excited to continue this journey with you.
Second Lien HELOCs are what most people have. So when people hear the word HELOC, even when I say First Lien HELOC, a lot of times they'll think of a Second Lien HELOC, which is, earlier we talked about being in the First Lien or Second Lien position. So you've got your mortgage, and that's your initial loan that you have, and you want to access the equity in your house for something. So whether that, traditional common reasons would be to pay for your kids' college, or do rehab on your house, or buy an RV, those kind of things. And so you want access to $20,000, $30,000, $50,000. You get a HELOC in addition to the mortgage you already have. So you end up with two loans at the same time. The way I like to think of it is that you have your mortgage, and then your Second Lien HELOC is kind of stacked on top of it. And so visually, it's sort of how I see it. And so this is not that. It is a HELOC in that it functions, both First and Second Lien HELOCs are open-ended loans. Money can go in and come out freely. a lot of second lien HELOCs also calculate the interest the same way. But the first and second lien position is what differentiates the two. So a second lien HELOC sits on top of your mortgage. If you have a mortgage and you want to get a first lien HELOC, it has to refinance you out of that mortgage. So it essentially pays off that mortgage. And so instead of sitting on top of your existing mortgage, this monster line of credit sweeps in, we'll call it, and pays off your mortgage and assumes the balance of the mortgage that you had before. And so if your max line, if your limit on your first lien HELOC is higher than what you owed, then at that point in time, you'd have access to the difference between your limit and the balance that you owed on your mortgage at that point.
I see. Okay.
Yep.
And we'll get into later about the risk factors and when some people would say like, hey, they're in the past, HELOCs have gotten shut down and banks have pulled the plug. It's my understanding that a lot more of them were second lien HELOCs versus first lien HELOCs, but both of them qualified for some of that stuff in maybe the 2008 crisis.
That's my understanding too. Yeah, we'll hit all that.
And so we can cover that. Okay, now let's talk about velocity banking.
Yep.
There are many people out there. I've had some people on my show that have talked about velocity banking. Just for context,
I've seen them.
Yeah. Okay. Awesome.
Kind of feel like I'm coming in the lion's den over here for what it's worth.
For context, I talk a lot about life insurance, and there's people in my space that I'll interact with, push back on in a very loving, friendly way. But it's important to me that we see pros and cons.
Yep.
And so velocity banking, in some cases, sounds similar to how infinite banking is being sold. And
see that. For
those of you that have seen, I've been pretty consistent on being like pushing back on a lot of the rhetoric when it comes to IBC. And so I want to first talk about like how velocity banking is sold, and let's talk about the pluses.
Yep.
But then I also want to give you like, hey, where you sit, is there anything that you want to correct? You don't have to call anybody out, but say like, hey, is there some things that this is true? Maybe this is not the way I would say it. Just like give you like breakdown from your perspective and know that no, won't be the lion's den, but I will push back if I have some hard questions. I put them at the end.
No,
I like to butter up my guests and then hit them with some hard questions.
That's okay. Well, and having seen your content and the way that you structure conversations, I respect it because there are people that have guests on or that do interviews and with the sole purpose of completely crushing them. Your willingness to have an open conversation, even if you disagree with someone, is the type of discussion that is worth having. Because if there are holes in what you're arguing, I would prefer someone call those out so I can either fill the holes or fill the gaps or improve. Right. And so to me, there is no one size fits all. There is no everything is perfect for everyone. And so if we claim that, then there are going to be massive holes in no matter what you say.
I agree.
And so I think a lot of it for me is with what I hope to achieve today with you is to be able to not just advocate for what we do, but also address some of those things that may be challenging, and if that helps me grow, awesome. And if we can help to either provide more perspective for others, then great.
Great. All right, velocity banking. Sell me on the concept of velocity banking.
So the funny thing is, I'm really crappy at sales. So when someone says sell me,
it's a classic sales line.
It is. Hey, I'm not a good
sales guy.
Well, so what I mean by that is I don't have a background in sales. I have a background in education. I was a teacher for 7 years. I focused on being the most effective educator across the board. I went to school, got my master's in education leadership. So my heart is in a place where I'm not really driven by money. I want to achieve things, and I want to do great things. And I want to be involved with things that are awesome, and I want to help people. And so if that means that I have to kind of sell people on things, then I can do that. But so that's kind of where my approach is. So that's kind of what I mean by I'm not a great salesman, in that like I don't identify as that, right?
Mm-hmm.
But that being said, velocity banking, a lot of times, so I have a broad definition of velocity banking. Sometimes when people say velocity banking, they're strictly talking about using a second-lien HELOC in conjunction with a first-lien HELOC. And there's a strategy that you can use to aggressively pay down your mortgage, right? To use the cash flow that you have with the two structures together in a way that allows for you to aggressively pay off the home, become debt-free.
Yes.
I apply the term velocity banking to also include using a first-lien HELOC. So my broad definition, we'll call it, is more about using a line of credit, using a HELOC, first or second lien position, to be able to aggressively pay down the home. There may be people that disagree with that, which is fine. So that's kind of why I like to precursor it that way, because there are people that strictly define velocity banking as a second lien HELOC strategy. So if I'm wrong, then I'll concede to that. It's fine. What we do is we teach people, to me, that the root of what velocity banking is that a first lien HELOC follows different rules than an amortized mortgage does. We already talked about it's open-ended, average daily principal balance. Because it works differently than an amortized mortgage, that means that you can work within this set of rules in a different way to optimize how it works. And so there's one mathematically best way to work within this rule set for the purpose of paying down debt, we'll call it. And so to me, that's what velocity, that's all it is, we don't have to make it some flowery, amazing marketing, tool. It's just like, hey, look, we know that a first lien HELOC works a certain way. Most people use HELOCs in a way where they borrow a bunch of money and they pay the interest and they might pay it back as they can. That's the general way to treat it. Or if they get a lump sum of money, they dump it in there to pay it down, or they try and pay it down aggressively. But in terms of really identifying how it works and working to completely optimize how this particular tool works for a certain goal, that's really what this is. And so it just comes down to there are a couple sort of steps with the strategy to fully work within the rules set of this loan. And so it calculates interest using the average daily principal balance. Yeah. It has a bunch of days in the month, and if a lot of those days have a higher balance, it results in a higher average, higher interest payment. If a lot of those days are lower, then it results in a lower interest payment. Yeah. And so if the goal is to create the lowest interest payment possible, then that means we need to just create the most number of days with the lowest balance. So that's kind of what I fall back to. It's like, that's the big reveal, the big secret.
And we probably should have said this earlier, that a 30-year mortgage, you're paying interest and principal over
at the same time.
Correct. Whereas first lien, you only have to pay the interest per month at a minimum. So whatever.
Good point.
Is that
yes. So you only have to pay the interest with a HELOC. And so again, for the kind of HELOC that I'm referring to, because there are some that are different, right? But how about this? We'll just set a standard that if I'm talking about HELOCs, I'll just refer to the kind that we have.
And it's not like your guys, it's not like other HELOCs that work like yours, but you're just...
Not necessarily. Yes, exactly. So all in all, if we know that the way to create the lowest interest cost is to create the most number of days with the lowest balance, I don't want to wait 5 days to get money in there, because that's 5 days with a higher balance resulting in a higher average. I want to get the money in there now. And I also don't want to put a little bit of money in there to create kind of a low balance, because I want to create the lowest balance possible to result in the lowest daily charge tomorrow. And so understanding that just leads into the first part of what you do, which is you deposit all the income that you make into the HELOC, all of it. Everything goes in here as fast as you can.
Yep.
That creates the lowest balance possible for you as quickly as you possibly can. So now everything's in there, all of it. And obviously we have to pay bills, we have to pay for our expenses. So since everything is there, there's only one place to pull from.
Yes. So it becomes your checking account.
It becomes your checking account. Exactly.
Unlike infinite banking, that some people will sell insurance as like your checking account, which insurance companies want nothing to do with. This product is designed for this. Like
it's designed for
you're
this.
totally fine with someone having a debit card or like having a card.
We've built it in conjunction with a checking account, so you function
It's
that
it's
too.
like a checking account.
Yes. So
And
we
so-
could get into that too as
So
well.
people will use that to pay off their credit card each month, and they'll car payment with that.
Yep.
And I was going to say house payment, but no, that's the
Nope.
product is built
Right,
in, so
right.
there's no house payment. And I guess
Groceries, utilities, your YouTube subscription, where your
Everything.
Apple TV, everything. So
everything.
because here's the thing, if and again, we teach the strategy. Keep this in mind. We teach the strategy in a vacuum. That we or whoever is teaching it teaches the strategy in the vacuum. From an education perspective, you're not going to teach a new concept to someone and then throw in all the variables that could also happen.
Mm-hmm.
The whole idea from an education standpoint is to teach the strategy in a way where it's like, this is what it is so people can grasp it and understand it.
Mm-hmm.
If that's where you stop, then you're not serving the customer.
Yes.
But we're well aware that there are many other factors that are available in life that are going to challenge or counter whether or not this is the best thing to do at
I
the
see.
time.
Yeah,
right?
yeah, no.
So-
But the concept is you get paid twice a month.
You pay twice a month. Everything goes in
Goes-
there to pay the balance down with everything you have.
You balance down, but then whatever you're available. So just to make math simple, I'm just going to use 100,000. That's a
An
pretty
easy number.
small house,
Yeah,
but it's an easy
fair enough.
number. So
Yep.
you have $100,000 house. You have $10,000. That you have to. So you have. Let's say I have 50 grand in there. I would have the availability of $40,000. Is that right? So if I had a $50,000 in my first lien,
Yep.
I don't think I would be able to have access to the full 50.
So I
Yeah.
can help.
Help me,
So if the home's worth $100,000, we have a limit of $90,000. So that's your max limit. If you owe $50,000 on the house, right? You owe $50,000 on the house at that point. You owe $50,000, but your limit is $90,000, which means you have access to $40,000 at that point in time.
Yep.
And so so that's the concept. So if you were to deposit $5,000 into the HELOC for that month,
Mhm.
that would drive down your balance to $45,000.
Yes.
Well, remember, your limit's still $90,000. So at that point, you'd have access to $45,000. But in terms of the strategy during the month, drive in the income pays the balance down to $45,000. Well, now we pull from the HELOC to pay our bills.
Mhm.
So this is where we kind of start to better understand when it works and when it doesn't work.
Okay.
Because it's not a fix-all for everybody.
Mhm.
It actually doesn't work for most people. And so then, it kind of begs the question of who does it work for? And so in a household that is tight on their budget, that has, difficulty managing their spending, that is living month to month, I would argue most people, and there's nothing wrong with that. I mean, I'll tell you, I'll get there in a second, but that means that the income is about the same as the expenses. And so if we think about the strategy, right, we deposit the money in and take the money out to pay for our bills. So if they're about the same, in that scenario, you pay the balance down with that $5,000 with the income to $45,000. Well, if your lifestyle requires $5,000 also, you take it right back out.
Yeah.
Right? So, what you do is you pay it down to $45,000. Does that create a lower average daily principal balance? Yes. Is that better than maintaining a $50,000 balance for the month? Yes. But if you drive in $5,000 and take $5,000 out, down by 5, up by 5, down by 5, up by 5, you would never pay off the house.
Mhm.
It wouldn't be a successful, it wouldn't be an option that would benefit that household. And like I said, there's nothing wrong with that. There was probably for the first 2 years that I was working with this loan, specifically, I didn't have one. And people would call me out and they say, Anthony, why don't you, you're saying it's the best thing since sliced bread. Why don't you have one? And I'd reply by saying, well, tell me again, what does it require for this to be a better option? And they said, well, you have to make more. If they understood it well enough, you have to make more money than you spend. Right. And I said, well, guess what? I've got 3 kids in daycare.
Yeah.
And it's $3,500. I was like, I'm calling my parents to borrow money. Like, I shouldn't have this.
Yeah.
For the same reason why I would argue that it might make sense for you because you're in a completely different cash flow situation than I am right now.
Yeah.
And so, So it's important to kind of name that, right? Because it's not a fix for that situation, right? It's not like all of a sudden because it calculates interest using the average daily principal balance, you get to offset all this interest and it pays it off. It really comes down to balance manipulation.
I see.
So yeah.
And so, okay, I think you did a great job explaining that, and it very much is attractive to someone who wants to pay off be debt free.
Mhm.
And I would argue, and I've said this publicly, that if you're gonna aggressively pay off your debt, doing it in a 30 or even a 15-year mortgage, like the way that Dave Ramsey recommends, like get a 15-year mortgage, so make the payment higher, and then aggressively pay that off and just pray to God that you don't lose your job or get disabled. It's like, because you're just like, oh, that's a terrible situation to be in. Whereas if someone aggressively pays off their mortgage with a first lien, if God forbid something happens, they have liquidity and control. And I think that is probably the best, like, for me, that's like the best like distinction between like, if I am going to pay off, if I'm motivated to be debt free, first lien would be how I would choose to go about it.
Mhm.
Or I would try to like, I would, there's no way that I would be paying fast on my 30-year mortgage unless I could have a type of relationship where I could get a second lien HELOC and it get updated as I aggressively pay
you aggressively pay it off. And there are a couple things with that. It's interesting, Dave Ramsey, he's not a proponent of this. And I think I understand why.
I think it should be, though. I really do.
Well, so I believe one of the arguments that I've seen him make, I'm pretty sure, is that when you get a first lien HELOC, you're going to become irresponsible.
Yeah.
You're going to overpay. Now, I would argue that if there's a household that doesn't know how to manage their budget and they're just learning about Dave Ramsey and they're listening to the things that he's proposing as safe things to do, right? If I need him to help me change my lifestyle, he is completely right. And all it would take is a couple people to get a first lien HELOC because he endorsed it and ruin themselves. And so I feel like he can't say it because the majority of the people that are learning about him that need him to help them, right?
It's totally
He's
true.
right. And so I think the fallout for him to endorse it would be too great of a risk.
That makes sense. And he looks at access and control of money as a negative because human behavior, a lot of human behavior would use that to spend.
Right.
Whereas I see that as security. I see that as opportunity. I'm thinking through the lens of entrepreneurship that most people are looking at, oh, I have $50,000. I can go buy a car. You have like, you should not buy that car at all. And yet you the money's there, so you're going to do it. And so I tend to agree with you. It's just like, from my point of view, if someone wants to pay off their debt, it makes me sick inside to know that the advice is to aggressively pay off a fixed.
If there were a Dave Ramsey graduate program, meaning there are people who he can identify who now implement the strategies that he talks about from a cash flow perspective, making money spends perspective, then that would be a sector. Like I would love
love that idea.
I would love to talk to those people.
You're like, you love Dave Ramsey. And you're responsible. And you're willing, you're open-minded.
And you're able to control your spend in a way, that with an amortized mortgage, you don't have to put much thought into what you're doing with it. You don't have to decide that you're going to cut out on things so you can pay down your mortgage. It is a fixed cost. So you've got your mortgage, you've got your car payments, you've got a couple other fixed costs. And generally, unless you have started to develop, a sense of financial control and planning, you just spend everything else. And so what you do is you create savings accounts where you don't see it, right? And you spend everything else because that's what lets you know how much you're able to spend this month.
Yes.
And so with an amortized mortgage, the thing I like about that is if someone wants to function that way, the amortized mortgage gives them the ability to have a forced wealth building, factor in their life. I would argue it's one of the main reasons why most Americans have built up any wealth Now, because you don't have to think about it, you're at the mercy of their schedule.
Mm-hmm.
And so that's kind of where we like to come in and sort of, exploit that, but you're at the mercy of their schedule, which you're not in control of it if all you're doing is following the schedule.
Now, let me ask you this.
Yeah.
And I want you to be able to talk about maybe the cons to the strategy as well. But if my whole goal was to pay off debt the fastest way, you have, let's say, person A and person B. Person B is doing velocity banking. Person A is doing, let's just say, like the Caleb Williams strategy,
Yeah.
okay? Person A is going to do a 30-year mortgage, and then they're going to aggressively put their money into a high-yield savings account. And then their goal is to, when their savings account matches the balance, they're just going to pay off the debt.
Okay.
And then hopefully, obviously, when they repay back the debt, they lose control.
Yep.
So maybe at that time, they refinance into a first lien.
Mhm.
Okay. Versus person B has a first lien, does everything that you're talking about. There's benefits on the daily balance, but the first lien interest rate is going to most likely be a lot higher than a 30-year fixed.
Yep.
Am I off on, like, I totally am with human behavior and all, but like from a mathematical standpoint, I feel like person A, if we really wanted to be technical, could pay off their loan faster from a pure interest rate standpoint. Because in a first lien, when your daily balance is better, but you also, like, the cost of spending or consuming money is whatever the interest rate is at. So in one way, you could say, you could look at it as like a 6 or 7% savings account.
Mhm.
But when I spend money over here, it doesn't cost me 7%. Whereas there's an opportunity cost, there's a control cost of every time I spend money. So while that's a benefit on one hand, it's a con on the other hand, which just ultimately becomes a wash. So I'm not as concerned about it's costing me 7% because I'm also depositing my paycheck in there.
Right.
And so does my question make sense? But like, if we really wanted to pay off debt, it's my belief that option A technically would be faster, but will someone do it? What I will say is if someone commits to something like this, they might have way more buy-in to stick to the program than put your money in a high yield savings account.
You completely teed me up.
Okay, so we didn't share notes. I promise. You can see my notes right here.
It's interesting. No, so we can create a lot of spreadsheets, and I'm not trying to be, not trying to use language that's patronizing, if that makes sense.
No, you're good.
But we can create a lot of mathematical formulas and spreadsheets that prove that one strategy mathematically is better than another. I can't refute the math. There are scenarios that I've seen on your channel where some show that they're about the same, right? Because you've got a tax advantage, tax write-off advantage with a First-Lien HELOC piece, and so that offsets. True. Right? That may offset.
That higher interest rate could actually be potentially an advantage because that's a higher.
In a way, right?
Yes.
Now that the idea of let's go spend a bunch of money so I can get tax write-offs is also, there's an argument for that too, or against that. But it really comes down to the rate, and the difference between the rate. But yeah, I mean, are there scenarios where, in theory, in on spreadsheets on using math only, that you could become debt-free faster? Yes, 100%, no question. You mentioned the fact that behavior is
Huge.
part of it, right?
I mean, that's Dave Ramsey for you.
And so, right, and so I would, that's where this has a monster advantage.
Okay,
my opinion,
because it's you're committing to I'm going to pay off my debt, and I'm so committed that I'm establishing a first lien. Like,
well, for a couple of reasons, and so back in the day when I was in my education days, we talked a lot about motivational theory, right, and different ways that people follow through with long-term goals. Reality is paying off your home in 10 years or 7 years is really short compared to 30. And it sounds like, sweet, I can get this done. But implementing a strategy a new strategy for the next 7 to 10, 12 years, the likelihood of someone introducing something and continuing with that gets lower and lower the more difficult or the more deviated it gets from being related to the goal.
So you're saying 2 accounts is more complicated than 1 account.
I'm saying that in a way, yes. So I'll go down the motivational theory rabbit hole. So there's this guy named Vroom, and he came up with this valence theory of motivation, one of the earlier ones. And there were 3 parts to it. One had to do with the first was, when you take an action, will it actually produce a result? Then is that result connected to the actual goal that you're trying to achieve? And then how much do you care about the goal? And so each one of those factors plays into motivating long-term commitment to a certain behavior. And so from a First-Lien HELOC standpoint, when you deposit money into the HELOC, when you drive in the money, that results in paying down the balance, period, right away. That paying down the balance has a direct result with the goal of paying off the house. And so,
Agreed.
And then if you care about paying off the house, every single time that you deposit
Every
money
month you're getting closer.
You're getting closer and you see it. So your actual action that you take to put everything in there gets you closer to the goal. Well, every time you take money out to pay for your bills, it takes you away from the goal. So it reinforces the positive behavior and puts a consequence on the negative behavior. So people that actually pay attention to that,
I agree.
I've seen them take it and run with it.
And that was one thing that when we first met, you mentioned, and you see it, like you see people's lives being transformed. You see the motivation, and that's impossible to argue with because.
And you know, I've got a small data set, right? But I can't argue with the people that I've talked to who've, you know, I did a testimonial with a couple, and he brought his wife in, and she said, we were planning on paying it off in 3, we paid it off in 2. And like, I remember, like, that's what it sounds like. I can just remember it. And does that happen with every single person? No, but the direct relationship between action and result and goal, I don't know of any other strategy or product in line with the strategy that has that direct relationship. You know, if you're putting money in a savings account, the theoretical and mathematical reality of that may be able to outperform something else, right? Like this. But every time you put money into a high yield savings account, it doesn't have a direct relationship with a goal of trying to pay off the house.
It's removed. So it might be less motivating.
Yeah, exactly. And so, I actually came ready with a bunch more motivational theories. But
cool. Bring them.
It doesn't have to be like motivational theory
That's
day.
what people subscribe for. They want their mortgage lender
to talk about motivation. So there are a couple more. Another one has to do. It's called the goal setting theory. Locke and Latham, and this is one of the most widely used most motivational theories in behavioral science. And so, what they talk about is that if someone wants to achieve a goal, they talked about the type of feedback you have to receive, and it needs to be specific. It needs to be directly related to what you want to achieve, and it has to be relatable.
Yeah.
Right. And so, every time people deposit money in their HELOC, it covers those 3 things, and so it reinforces the behavior. There's another one. The guy's name starts with a G, but it has to do with implementation and the architecture of the structure of the strategy you're going to use. And so that one had more to do with the more manual decisions you have to make to achieve a goal, the more likely you're just going to quit.
Yeah. There's power in automation.
Right. And so it's like there's the automatic, right? So the First-Lien HELOC, we haven't gone into this yet, but we built ours to work in conjunction with a checking account.
Right.
So in order to implement the strategy, you deposit to a checking account and use a checking account to pay your bills. You don't have to learn a new strategy and a new concept, a new procedure for you to think about and decide on. You just deposit money.
Yes.
And so anyway,
So let's before I hit you with some other questions, what are things that you want to call out that you're like, hey, this is maybe something that gets overpitched, oversold, or a misconception?
Yep.
One of the questions that I'm going to ask you, whether you bring it up or not, is this simple interest versus compound amortized interest and all. would love, and that actually came up when we talked originally. And that's why I was like, you know what? I would love to have you on because you are a big fan of this. You don't apologize. I love talking to you, but yet you're also willing to, call balls and strikes.
I'll start with the ones that played in my benefit first, then we can get to the other
Perfect.
ones. I'm biased just for what's right.
That's good.
But I think one misnomer is that people hear the way that others pitch this or offer it or try and generate attention. And their assumption is that those people, maybe me also, I'm not sure, I haven't gotten feedback specifically, but that they assume that means that person or that entity thinks that everyone needs to get it, right? If there are people that are doing that, they're wrong, period. I haven't come across people that have said that, but if that's the case, they're absolutely wrong.
Yeah, if you're selling this, like we'll fix all your problems and everyone needs this.
It's the absolute best for everyone.
Yes.
That's completely incorrect.
Okay.
So I think that's one sort of mistake that people make. I think secondly is that people assume that when we or when people who teach the strategy talk about how it can be used to become debt-free really quickly, that they assume that that's the only way we understand it can be used. And that's also wrong. The reality is that this is a financial vehicle. It's not just a mortgage. It's not just a tool to become debt-free. The reality is every dollar you pay into this, every dollar you pay down, you have access to as well. And so it can also be used as a leverage tool as well also. And so we're aware of that. Does that counter, if you're going to pull $100,000 to buy a rental home, right? Does that counter the ideology or the ideal of becoming debt-free? Yeah, but is it against financial best practice? No. So there's a much more developed understanding of how people can use this. And the thing that turns people's heads is pay off your home in 5 to 7 years. And so that's what a lot of people use. But that, I think, to assume that's the only way that they or we understand how this product can be used, that's another misnomer.
And I'm glad you mentioned that because that was one of my questions is there's such an obsession on paying off your house or being debt-free, and that's a very emotional thing. That's why, Dave Ramsey does a different version. I actually like your version better, but it's like that for me is like, man, I don't necessarily understand the obsession around paying off. Like I get the emotional obsession. I just don't, like from a math standpoint, I'm like, why would you want to do that? Now, I may be more motivated to pay off a higher interest rate, but if I have a mortgage that's 4 to 6% locked for 30 years, I'm not necessarily going to be like trying to be super motivated to pay that off because I don't necessarily see myself in debt. I see that as a tool as well. And so that's why this whole concept of paying it off fast, it's for me, it's sometimes a head scratcher. And then as I'm saying that, it's also like, that's the thing that will get people motivated. And if that gets you to first base, amazing. And then we'll see what happens after that.
And so one thought is, I think about financial practice development, we'll call it. And so I would put Dave Ramsey at the forefront of that, his ideas, right? We have people who need to be able to control their spending. And whether you're making 40,000, 80,000, 160, I've heard that there's a generalization that doctors are really good at spending all their money, right? I don't know if that's true or not, but whether it's 300,000 a year, he helps people with the baseline of what I would argue the majority of all other financial strategies require is your ability to make more than you spend. And so he helps with that. Well, then it's like, okay, how can we create safety nets? How can we protect what we have, right? Sometimes it gets into the debt, the debt reduction, pay down debt piece of it. But the way I like to think about it is that as people pay down debt with an amortized mortgage, because they don't have access to any of the money, it doesn't allow for them to think thoughts like, well, what if I took $100,000 and did this with it? Unless they're naturally investor minded.
Right.
They're not, the fact that they don't have access to it doesn't open their minds to think those thoughts.
Because when can you start qualifying for a second lien? Like when can a person get a second?
Well, you can. I would argue you can probably get a second lien once you are. Some second liens can go to 90%. So if you want 5% equity, you're at 85%. You can get it. A 5% second lien HELOC. But in terms of paying down the house, I would argue that if you don't have access to the funds, unless you're naturally investor minded, you're not going to have a pool of $300,000 at your disposal today.
Yeah, that's fair.
And so, and again, like this is all, theory at this point, but if someone's sitting on $200,000, $300,000, $400,000 at 8% available today, it allows for them to think the thoughts, hey, what if I were to take this, right? And so it's a much easier transition into, well, why don't I connect with people that are doing this, right? Why don't I partner with someone who's a real estate investor and I'll fund half the deal and he'll fund half the deal and I'll get part of the,
You're saying Nelson Nash in his book talks about the golden rules. Those who have the gold make the rules. And you're saying that there is a difference, even though it might be less attractive to access money, you still have access to that money. Whereas if someone's traditionally paying off their mortgage, doesn't have a second lien, it's not even like, it's something that they're not even aware of. It's there's people that would argue that that's better because they're not going to take their money and spend it or lose it on a bad investment. But then on the flip side, you could say that's amazing because the opportunity could be to take a loan at 8% and make 20%. So there's pros and cons, and I tend to value the more optionality control because that's where I default. But if I'm defaulting towards America, I'm the exact opposite. Just like generally, no control, no options. For me and for hopefully this audience, more control, more options.
Well, and I think that's a good thing to keep in mind, which is that with any strategy, you have to consider who you're trying to attract and who you're offering it to. When I talk about the first lien HELOC in terms of leverage, I'm really referring to people that already know how to manage their spending. They're not buying assets that are going to depreciate. They're not the stereotypical consumer mindset, right? They're growth-minded individuals. And so I sort of like to flip the script a little bit as well, which is, as you pay this down, keeping in mind that it's available, let's just say it is at 8%. Usually the comparison is 8% first lien HELOC versus 4%, 6% amortized mortgage. Well, now if we're talking about access to money, now it's more of a capital conversation. So you have how quickly can you access the money and then at what rate can you borrow it at? And so this gives you access to money immediately. And again, it has to do with the available equity that you have. But $400,000 at 8% is pretty competitive when it comes to some of the other options that are out there.
We'll talk about that in a second. Let's talk about the simple interest, compound interest, and there's things that I've seen where what they'll do is they'll say, look at how much interest you're saving, and they'll take what you would have paid over 30 years in a fixed mortgage, and it feels like, and again, I don't believe it's done maliciously, but it's from a math standpoint, because I grew up on the understanding apples to apples. If you're going to compare something, you have to change something. And even like I'm in the process of building a calculator, and there's something that was in quote unquote my favor, and it bothered me so much. I was like, we can't have this because it was, in my opinion, intellectually dishonest. I see that happen everywhere, by the way. But I see that in the velocity banking space. I'm curious to hear, from your perspective, what is your perspective on when people say, well, they use the things like simple interest, amortized interest and all, and then have you seen when people will use how much interest you're saving, but they're taking 30 years and you paid it off in 40 years. And so it's well, you're showing me an apple and an orange.
So in terms of the simple interest versus compound versus amortized, I've seen it explained multiple ways where they'll say you're paying amortized interest with your amortized mortgage and simple interest with a first lien HELOC. I would agree that in general, that's incorrect from a technical standpoint. Again, I'll kind of go back to my education days.
Okay.
When you're introducing a concept to someone that's new, in order for them to be able to access that concept, you have to present the information in a way that they can access. And so what I mean by that is there's this thing called zone of proximal development, ZPD, which is that different people come to the table with different levels of knowledge. And if you introduce a concept that's way beyond what they understand now, they won't access it. They won't connect with it. And so, what I see is that people are simplifying terms. They're creating an overly simplified version of what the definition of the thing actually is in the financial sector in a way that turns more heads.
Yes.
Right.
And an example of this is over a 30-year mortgage, you'll pay for your house twice just in the interest.
Right.
And if you do this over here, you're going to be able to pay off your house in 5 years, pay a fraction of the interest. And so you essentially are going to forego having to pay the bank $500,000 worth of interest, which is actually true. That's a true.
So,
but
right.
I'm just like being fair. The problem is it's a little bit misleading because it's like, well, you're using a 30-year example over here, but we're not showing the benefits of potentially over 30 years is a long time.
Right.
And you could also look at what someone could invest their money over 30 years, and it potentially would be a lot bigger than what the bank is getting paid.
So for that particular scenario, I would disagree with that a little bit.
Okay.
Because the reality is there are a million different opportunity costs that we can look at and consider. What I do see is that, and understand is that we have a 30-year fixed rate mortgage and we know how people treat it in general.
Yep.
Right? So assuming that that's what you're going to do, right? If you are, if you're someone that isn't already overpaying on the loan, right? We can assume that you're going to treat it that way. Yes. And if you don't, and we're wrong about that, then tell us or tell someone and we'll include an additional payment for you, right? But if we assume that you treated your loan this way, right?
Yeah.
But then if you have a certain amount of cash flow and you were to do this with the first lien HELOC, simply here's the outcome that you'd get here, and here's the outcome that you'd get here.
Right.
And so
the difference is you're over this. This happens with infinite banking too. It's the cash flows are different. Like if your mortgage is $4,000 and you're putting $10,000 into first lien HELOC, like of course it's going to be different because you're literally putting more money towards the loan.
Yep. You pay it down faster.
So then again, an apples to apples comparison is like, well, if you just put that other money towards a high yield savings account, like that would be. You get what I'm saying? Like from a comparison standpoint, it's like, of course it's going to be different because on one hand, your behavior is changing, and on another, you get what I'm saying? Like it's totally like when you opened up about the behavior, like I'm 100% behind that. And I actually am a fan of this strategy when it's like, these are why we're using it because of these principles. But then it's like when you're going to go down the math lane, but the math is, in my opinion, not apples to apples. It feels like that's where I kind of like push back.
So, and I can respect that.
Yeah,
I can. I would argue that that we can create a myriad of different other things you can. I mean, which one do we want to use? High yield savings account, and do we want to put it into a life policy, right? Do we want to assume that they're going to invest in some real estate and then lose some and then win some, right? And so from that perspective,
I think like
which of the million other options that are available, which one would you choose to compare?
I think worst case scenario, it could be a 0% checking account, and then best case scenario, it could be a 12% mutual fund that Dave Ramsey gives them. You know, that would be like the range, but even if you put that money into a checking account at 0%, it's not going to perform as good, but you're at least going to have from the same cash flow perspective. Because, and again, like I'm a fan of like person A does this, person B does this, person A, has these benefits and these cons. Person B has got better behavior. It's built into one. It's these are the things, but it's like from a cash flow perspective, like the behavior has changed. Now there's truth to say that sometimes people are changing their behavior by buying into the first lien. So like it's like almost like going to the gym doesn't make you strong, but if you go to the gym every day, there's a higher likelihood that you're going to work out. So there's that aspect. And maybe it's just my like too logical brain. I'm like, I get that. And I also am like, hey, I still struggle with people on the front end selling it that way. Yeah. But I try to be consistent in the life insurance space. I try to be consistent every area when it comes to that, because you could almost justify anything at a point if you use that logic where you're like, hey, if you do this, it might not logically make sense mathematically, but your behavior will change. And as a result, you're going to be a better human. Right. And you do a lot of like life coaching is like this. Right. Network marketing can get into this realm. Like there's Correct. Elements of really good areas of that, but then there's a lot of aspects you're like, okay, that feels like a stretch. That's fair. And I mean, I guess to play devil's advocate, if we're talking about opportunity cost. Yes. There's another factor to this too, which is if, again, there are a number of if-thens, but if someone has a good equity position in their home and they get a 90% loan to value and all of a sudden they have $400,000 in their HELOC. Suppose they were to take that out and borrow at 8% and make 15 or 20% somewhere else. We can run those scenarios. Yes. And so I don't think that anyone here is averse to running those scenarios. I think that there's just such a myriad of opportunities that are available. At what point do you do you just decide, hey, look, here's what it is, and so there is another side to it too, which has to do with leveraging the HELOC as well. Yes. And so you're saying like version 1 is be debt free, but then when people start really getting into it, they're like, no, this is just a tool that gives me a lot of control, and then I can use this money to potentially buy assets that's the thing, is that will prolong my debt a little bit, but might grow my balance sheet and cash flow. So when I see people who, in my opinion, seem to be more developed from a financial standpoint and are using the First-Lien HELOC, they don't care about becoming debt free. They don't care because, you've got the Dave Ramsey become debt free, but then you've sort of got the opposite Kiyosaki, where it's like leverage all the debt you can, right, to create cash flow producing assets, because that creates cash flow, where to the point where if you wanted to pay off all the debt tomorrow, you could. And so that's where the people that teach the strategy, the hook is pay off the house really fast. But from the people that I've seen that really specialize in this in itself, that's not the end goal. Coaching people on how to become debt-free is not the end goal. Yes. The end goal is to help them develop financially so that they become essentially self-sufficient from a business and growth standpoint, to the point where they're leveraging their HELOC to buy cash flow producing assets to help build businesses that are cash flowing to the point where if they wanted to become debt-free tomorrow, they could. Yes. Right. So it's an interesting transition, because people turn their heads to, like you said, like this love for this idea of becoming debt-free and paying off the house is what generates the most attention. But from what I've seen in the industry, the people that focus on this use that to help people learn about this as a financial vehicle to help grow and help develop financially, not just to help people pay off their home quickly. Anything else you want to mention before I hit you with some other questions? This is good though. I really, this has been, hopefully you find that this conversation. I do. No, this is great. This is really good. Let's see. We went down the presentation mathematically standpoint. There's also sort of the terminology language wise that we didn't hit quite as like as simple hard. Interest versus compound versus versus amortized interest. Yes. Is there a thing as just simple interest?
Simple interest is a thing. Yes.
Okay.
So simple interest is essentially paying interest on the balance that you have at this point, not necessarily paying interest upon interest.
Yes.
So if I flip the script, and instead of using simple interest versus compound interest, when I compare to paying interest, let's think about it if we're giving someone a loan, right? Or we're investing. If I'm investing in a simple interest investment, and it generates 10% per year, and it's a $1,000 investment, I will only generate interest on $1,000
Yes.
period for the next 5 years.
Doesn't matter if my balance is double.
Exactly.
Yes.
Right. Doesn't matter if I take distributions or not. A compound interest would be on, year one, I would make interest upon, 1,000, which would be $100, right? So then my balance is now 1,100. So now I earn interest on 1,100. So it's interest upon interest. So if I think about the definition of that, then yes, then that's the way that I like to think about it.
Yep.
So now let's come back to the mortgage standpoint. So an amortized mortgage is actually simple interest because you pay interest on the balance and you are not able to pay interest upon interest. To kind of go back to simplifying terms, I don't use industry language when I'm talking to people, right? If I'm talking to bankers or lenders, I do. But if I'm talking to regular people, I can't expect for them to be able to follow me if I'm talking in terms of DTI, LTV, all those kind of things. And so what I do is I use language that I know they're going to connect with, that I know that they're going to be able to understand, that have meaning to them. So when people use the term amortized interest, is it wrong? Yeah, it's wrong. No question. But what that does is that represents something to people that they can connect with in terms of a meaning. Is the definition per, financial, definition, technical definition correct? No. But to me, I don't have an ethical issue with that because what they're doing is they're using a term that people can relate with.
To teach. And the reason it's technically wrong is everything, going back to apples, you have to factor in opportunity cost and other things. And so sometimes someone might say, well, I'm paying a simple rate, but the fact that your money's leaving you and going somewhere else has a compound effect. Does that make sense? So
sorry, only because
what I am big on is, and that people will do this on the insurance side as well, is they'll say like this is you're paying an amortized loan down or a simple interest. Okay, so like the fact that you pay your interest payments each month kind of deal. That's like it. You could say that doesn't compound kind of deal. So what I'm saying is, anytime money flows from you, there's a compound effect of that. If I go and pay for a Starbucks coffee at $5.
Oh, I see.
That coffee is going to cost a lot more. So the fact nothing in general, the way that I view things, is static.
Okay.
So that's why when I even said, you're totally right. Simple interest is but that's the thing that I'll even say.
I get where you're coming from now.
Okay.
So if that's the line of thinking, then it's impossible for there to be simple interest.
Right.
So which means like, so essentially like, as you pay down any loan, if that loan's interest is based on the balance at any point in time, then you paying down the balance has a compounding interest on the overall amount of interest that you're going to pay. And therefore you're defining that as, we're calling that compound interest, correct?
Yeah. Okay. Yeah. And I'm pretty much just saying that the people that talk about amortized interest as like you want to pay amortized interest and you want compound interest. That's more of an infinite banking thing than anything.
Okay.
But it's like, I've had videos where I'm like, guys, this is at the same rate. It's the same thing when you factor in the other side. And so most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built The Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock The Vault. All right, back to the video.
So from a First-Lien HELOC standpoint, and the use of amortized interest versus simple interest with a First-Lien HELOC, I was talking with someone couple weeks ago about this exact thing. And what I said is, I was like, the thing is, like, some first-lien HELOCs are built where the first-lien HELOC is able to pay, it automatically pays the interest, which means then you're paying interest upon interest. And they're like, yeah, you're right, completely. But what that means is that someone hasn't made their payment. So if you don't make your payment here, and again, I'm coming from a definition of I guess a banking, we'll call it, lending definition of simple versus compound as compared to the way that you just presented it, if that's fair. So he said it can become that if you don't pay your balance, but who teaches that? Who teaches you to not pay and then, and so that was a really sort of, for me, kind of an aha moment where it's like, yeah, you're right. Like, if you're not following what you're supposed to do, right?
Yeah.
Then it can become that. But if you're doing what you're supposed to do, what people teach, then what you're doing is you're not paying interest upon interest. You're paying interest at the balance at this point in time on the principal balance. And so, that made sense. And so, I think that there's a balance between following industry definitions, right, and being called out for maybe using more layman's terms for people to connect with, right, as compared to like, we're misleading. We're
I just find
purposely misleading.
I just find it ironic around, like, I would just suggest to say, hey, we're going to help you pay off debt and then talk more about the behavior. Like, the reason, like, studies show that if you do this, you're going to be more motivated. And as a result, you're going to pay off debt faster. Sometimes, and again, I won't call anyone out here, but sometimes when you look at presentations, it makes it actually feel like this is a secret. It's like, this is the loophole. and as a result, and it's like, no, you literally can't pay off debt faster by having a higher interest rate. So like that's probably the only thing that I would, like, draw the line on. I actually agree with most things. And in this next section, I'll, like, talk about where I think this fits for people and maybe where it doesn't.
Right.
And you can disagree with me on that. But I don't have a problem at all with this. It's just that probably articulates the best of where I'm like.
So I completely agree with that.
Okay.
I've had conversations.
I was not expecting for you to say that.
But and here's why. I've had people, and again, this comes back to the behavior piece, right? I've had people where we ran scenarios with them. We have a calculator as well. Anytime people want loans with, want a first-lien HELOC with our team, we make sure that they understand the concept.
Cool.
We reteach it to them if they need that, right? We do have a calculator that runs the scenario that you're talking about where you drive in all the income used to pay your bills to project how long it would take to pay off a house. And I was talking with a couple, and the husband, he said the same thing. He said, well, what if I just took all the money and put it in the mortgage? And I said, it'd be a whole lot faster. Right? What's your rate? It's like, well, it's lower. That'd be less. Let's see, right?
Yeah.
So we ran the scenario with him, and he was going to pay it off faster, right? And he said, well, I just can't get myself to do it. And I said, that's fine. My question is, are you already doing that? And he said, well, no, it doesn't matter though. I could do it. And I said, you're completely right.
Yeah.
Mathematically, but if it's such a great idea, if it's such a safe thing to do, right? If putting all your money into a place that you can't take back out is such a great idea, like, are you doing it now? And he's like, no, right? And so I ended up losing him, right? And I was okay with that because, the reality is that I don't believe, if someone came to me and said, hey, I want to put all my money into a place where I can't take it back out so I can pay off my house really quickly, is that a good idea? I don't know of anyone that would advise that person to take that action. And so, so that's one of the things that makes this feasible, right? But in terms of that, of your statement, your argument, like, yeah, you're right.
Okay.
And so if people come with that, I can't refute it.
Well, but I appreciate that because it would be a lot harder for us to have a conversation if that was like,
if I may ignore that.
Well, disagree, and then it would be like, all right, let's get the calculators out.
Yeah,
So now let's talk. The only other issue that I have, it's not necessarily an issue. hear me out here. So I worked at a bank before I started BetterWealth.
Okay.
And it was interesting because I tried to work in every department I could, and I would spend a lot of time with the CEO of this bank. And you know how a lot of times we could look at a 30-year mortgage and all the interest that gets paid over 30 years. But when I was working at the bank, the interest rates were super low. I mean, they were in the high 2s, middle 3s.
Yep.
And it's interesting for his perspective because I was learning. I'm like, why do you sell these things off? Like you originate a loan and then you sell it off. And he's like, Caleb, like this would be suicide if we had to keep this on the books. 30-year fixed. And then you start thinking about like, yeah, the 30-year mortgages, you could look at them as a negative thing from a consumer standpoint. But they're actually on a different side. They're especially if the U.S. dollar is getting less and less valuable. You have a 30-year fixed put essentially on something that is guaranteed to go down in value because we're printing money. And it's so valuable that most other countries don't have 30-year mortgages because there's no, like, they wouldn't hold it. I actually think it's a dumb thing for our country to do because I don't think it's actually smart. Just for the record. Why? Because they're literally they're doing what no bank, including yours, would do. Like you wouldn't have a whole portfolio of 30-year fixed mortgages, and yet we do that and we sell them to these conglomerates. So point I'm making is with that logic, then it's like, how can that two things be true? How can they be so unattractive that no one would want to hold them, that the government has to get involved, and yet these are the same instruments that they're evil, you should get out of. And so logically, I look at the 30-year mortgage as actually one of the greatest tools to build wealth because number one, I get no other financial product I know that will give me a fixed 30-year fixed. Like from a risk management standpoint, that's like risk management heaven. Backed by the US government. Pretty interesting. And so like that is that. And maybe I'm too heady here, but like from like a big picture standpoint, shame on the government for allowing it, but if they're going to allow it, just like they're going to allow tax breaks, whether we need to raise more money in our country, but if they're going to give me a tax break, I'm going to take it all day long. I'm not going to be like, you know what, government needs more of my money. So okay, with that, then we just stayed from an investor standpoint, I would invest in first liens all day long because it makes sense. It's safe. I'm not worried about the banks going under, but the interest rate's a lot higher. So from that logic, what is your thoughts on that? Like, have you heard someone argue that before where it's just like, just from that standpoint, is there a world or a conversation where like the 30-year mortgage might not be as bad as maybe people see it? Because even that person that it sounded like you lost, if I was talking, I would be like, yes, what you should do is fund a high yield savings account and then pay it off, but please don't pay it off faster, because you lose control unless you get a second lien. So you weren't wrong in what you were saying there, but like I'm just one, like I see the 30-year mortgage as still an amazing tool. The caveat is people that it enables them to buy a house that they should never have bought in the first place. So it still doesn't give you a free pass to buy things that you can't afford. But I just would love your take on that. Like, I know you are in a bubble, but so you don't have to agree with me. I'm just
So in terms of, I do see the 30-year fixed rate mortgage as an extremely valuable tool. I agree that if you can lock in for 30 years, that creates, you're mitigating risk like crazy. So I think one of the main reasons why banks sell has to do with liquidity. I faced that before with us. You know, we have an in-house product. The bank has certain buckets that that's the way I like to think about it. They have certain buckets that are allotted to different types of asset classes, and mortgages is one of those. And so, and the bank has to report that to the Fed. Now you've got this, we can lend 10 times X amount, but at the same time, it's not, they don't just get 10 times the money. They actually have the ability to borrow 10 times the amount of money, but it's not like they just have it. And so I think that's something that it's like, you know, this fractional lending is like, they don't just have 10 times the money. They're
not in the vault. Just
It's like, oh, by the way, like Fed, give me 10 times what we have in reserves. That's not how it works. Because it comes with an interest rate. So they call the cost of funds.
Yes.
And so the challenge that comes with with banks is that if they're holding a ton of assets at 2% and all of a sudden the cost of funds goes to 4%, they're upside down. And so being able to sell something that's fixed for that period of time allows for them to then true up to the market.
Totally.
Right. And so Fannie and Freddie, I don't know about Fannie and Freddie, right? Meaning like I don't know if they also have a cost of funds as well, right? So I don't know what makes them upside down or not, but they also have, they hold the majority of loans. So if they're sitting on the majority of 2% loans, then they're not making as much at that point in time, but they also have the majority of mortgages here in the United States. So it's a balance between all that. So, so all in all, it's important for the balance sheet on any bank to true up to the market so that the assets they're holding are not producing a rate that's lower, right?
No, I agree
so
with
that's
that.
where the first lien HELOC comes in because it follows the index. It follows the market.
That's my whole point. Is I actually believe that every mortgage should be like a first lien HELOC. I'm not just saying that from a actual.
Can you say that
sustainable,
again?
Yeah, from a sustainable, like from a country standpoint.
Yeah.
From a sustainable standpoint, the first lien HELOC is, I think, much more fair.
Yep.
Much more fair than you're telling me that this is why we have problems that like some people are locked in at a 2.5% and they're not selling their home.
Right.
You know, it's like, it's actually not fair that they got a 2% mortgage
at that point
and
because
I'm
they
paying
happen to
6%.
buy. Right.
Like that's like from a standpoint, like it creates booms and busts. And so it actually from like an economic standpoint, First lien HELOC should be the main thing that people should do. And I actually think housing prices would come down because everything, it would
stabilize.
I think it would stabilize.
Yep.
But the point is, that's the same thing for me saying, I don't think that the government should do certain things, but I'm still gonna do tax strategies if I can get a tax write-off.
Right.
So my whole point is like, I don't love the 30-year mortgage from the government standpoint, love the fact that I get to take advantage of it.
Right.
And it's almost like if it's available, even if I had the money to buy cash for the house, which by the way, I wouldn't buy a house if I didn't have the capital to pay it off in a year or two or have it. But then it's like, Caleb, why did you get a mortgage? Because this is from what I explained early on.
Right.
So I'm trying to be consistent with what I'm sharing with you.
So I'll add to that and provide a different perspective.
Okay.
I've learned through, experiences in the financial sector and working for banks that profit is one part of it, but mitigating risk is almost, and it depends on where you are, a lot of times more important than making money.
I agree.
And so that's a piece that consumers don't necessarily take into account. The risk that's associated with a particular type of asset is analyzed a whole lot more than the amount of money it can make.
Yes.
And so thinking about it from that standpoint, I like to run the scenario. If I were to provide only first lien HELOCs to the cross-section of all American homeowners, what do I think would happen?
I mean, I think it'd be
terrible.
Yeah. Yeah. For the same reasons that you
exactly
said.
Right.
Yeah.
It's because Dave Ramsey would be right.
Mm-hmm.
Like what it does is it exacerbates it.
How about this? The product would be first lien variable interest rate. That actually is more better.
First lien amortized.
The fact that they fixed interest rates are the thing that's bad for U.S., good for humans.
Perfect.
So I agree with you.
I'm in line with that. Because and again, this is all I do, right? And so, but the reality is that a lot of banks won't enter the space because they don't know how to find the right customer.
I see.
Who'll treat it the right way.
Yeah, because someone it could create a little bit more risk because they could spend all their money up to 10% of their, and then if the house drops by more than 10%, then the banks could be underwater.
Let's go even further, right?
Yeah.
Salesmen have a stereotype where they're just, the job is to sell.
Yep.
Right. So I'm going to do whatever it takes to sell. My team could go out and say, hey, are you worried about losing your job? Do you want to fall back? Do you want to have something to fall back on in case you lose your job? Would you love to just have an interest-only payment
Yeah.
Yeah, I was on the phone with, you mentioned cars, I was on the phone and talking with the guy, and 2/3 the way through, I kind of like to use extreme examples, and I said, this is when the new Broncos were coming out, and I said, he was like, can you use this to invest in real estate? And I said, actually, you can do it for anything. You could buy a brand new Bronco with your equity. And he said, sweet. And I was like, oh no. I was like, no.
To see
I was like, no. I was like, I got to tell him not to get it.
Yeah.
And I did. And I was like, I spent the next third of our conversation convincing him he shouldn't get it.
Wow.
Now, from
You got it anyways.
No,
Oh, he did?
No, he
Wow.
didn't get it. No.
Wow. Because you knew that would be it would cause more damage because he would use
it's the wrong mindset. It's a
Yeah,
consumer-driven mindset,
Okay.
not a financial responsibility mindset, right? And so that was a qualitative call that I made, but the way that he said it and what he said, I was like, man, like that was my extreme. You should never do this thing, right? And he was like, that's awesome. And I said, to myself, I was like, this isn't gonna work. So if people were, if you introduce this to everyone, right?
Yeah.
People would ruin themselves with it.
Yes.
Because it requires that type of financial discipline and responsibility.
That's fair.
And
next question I have, we won't mention your bank, but banks that do this, a lot of times they keep them in-house, but sometimes they sell them out.
Yeah.
The other, just from a risk management standpoint, I just mentioned how they're offering a 30-year fixed rate that gets backed by the government.
Yep.
From a risk management standpoint, pretty like I feel like I can count on that from a standpoint of guarantee. On the flip side, you have a first lien variable interest rate that could be maybe locked in year to year or month to month. Okay, so interest rates could go up or they could go down. And I love the fact that I have liquidity. We'll talk about that in a second. But I also, it's on the books of a bank that could technically change the rules. Now, I think it's fair to say that if banks change the rules, they're never getting back into the game.
Agreed.
Like, so they wouldn't be able to just say, you know what, we're going to pull the plug over here and like roll out a new product. Like they lose trust, period.
Agreed.
But that still is a risk. I don't know how big of a risk it is. I would want to hear your feedback on this. Like, you won't have to use your employer, of course, but are there banks that if you're going to do a first lien HELOC, like don't just look at the rate, maybe look at how long they've been, their balance sheet, their commitment to this, because all can be fine and good and you're committed to this, your paycheck is going into this thing, and then boom, they change the rules. And now you're really stuck, or you have the potential of being really stuck.
So it depends on which rules you're talking about. There are two entities or two things to consider. One is the functionality of the loan itself and how it works. The terms of the draw period, which is the point at which it's open-ended, and then what happens after the draw period is established by the contract that's signed. And so a bank can't renege on that.
Yep.
Right. And so whether it's an open-ended line of credit that's secured by your real estate and it functions this way for 10 years, and then it functions this way for 20, or it functions this way for 30, that's a given.
Okay, so there people are signing documents that say like over 10, 15, 20, 30 years of this is how this product's going to work.
Yeah, it's a mortgage document.
Okay.
And so we do a lot of work to differentiate from mortgages, but the reality is it's a mortgage in the same way that if a bank holds your amortized mortgage in-house, they can't change the terms of that contract.
Okay, so with the first lien, this is good for me to know. With the first lien, people are signing documents that pretty much say like, hey, these things can change, but there's certain things that are going to stay the same for 30 years.
Yep, it's open-ended. So
open-ended for 30 years.
So our particular product's open-ended for 10 years, and then it has a 20-year payback period, which it's closed-ended, which
could be.
It turns into a closed-ended loan at our particular bank, right?
Okay.
It turns into a closed-ended loan for 20 years. And so the ability to access funds stops at 10 years if you don't get another first lien HELOC. So
you could refinance it from there.
Yeah, you can.
But when you refinance it, is there more fees tied to that?
Yeah, there are,
Okay.
because so that's another piece to consider too.
Yep.
This loan is a refinance. So when people say the word HELOC, they think of second-lien HELOC, which I'm opening up a line of credit on top of my mortgage. Well, here's what that transaction looks like. We call the bank, and I'm generalizing, but we call the bank and I talk to maybe a teller, and I say, hey, I want a second-lien HELOC. And say, sweet, what's your address? Give me some information. How much money do you make? I tell you how much money I make, and they probably believe me. And they type that in the thing, right? And then they, we're going to run an appraisal. Well, they click a couple buttons and order an automated appraisal that uses algorithms that are available, but no one's going out to the house, right? The closing is they send you some closing docs and you sign and it's fine. So compare that to a mortgage refinance, just like a mortgage purchase, where you're applying, you finish a complete application. There's a hard credit pull. We ask for a bunch of docs. There's a full appraisal. You have title. You've got state fees that are all associated with this. And so the transaction for a first lien HELOC, because you're replacing the mortgage that you have already, is a refinance. And so for me, in terms of closing costs, they're prepaids too, but in terms of closing costs in particular, the way I like to think about that is people have to do work to get the transaction done. You got to pay people to do work to get it done. Yep. And so you've got the bank that has to do work. There's bank fees. You've got the appraisal. You've got the title fees and the state fees. For us, when people come around and they want to refinance again into another first lien HELOC, we waive the bank part of that. That's the part that we can control. Yeah. But then the appraisal, title, and the state fees are still applicable at that point in time. So for our particular scenario, that's the case. Sometimes you can find banks out there that will waive those fees. My opinion is that they do that because everyone assumes that for HELOCs, it's supposed to be free. So they wouldn't choose it. They wouldn't choose a first lien HELOC if it weren't free. So what they do is they either eat those costs or they have their title company eat some of the costs too. Reality is the costs are still there. But what they'll do is they'll impose a prepayment penalty where if you get out of it, because basically they have to earn earnings at that point. So I know that went down a little bit more of a rabbit hole than.
No, I appreciate you mentioned that, and it actually proves my point that it wouldn't be very smart for you to have an open-ended loan in perpetuity, because it would be a potential risk to the investors to say, if we ever want to get out of this thing, we're essentially like, Anthony's got to die before we get out of this thing. And that could create bad incentives.
Another way, ours is structured to have a 20-year payback. So if you pay down the loan, whether you owe $20,000 after 10 years or whether you owe $250,000, it spreads over a 20-year payoff period.
That's okay. It's amortized? It's
an amortized.
Okay. Is it amortized or? Yeah.
It's amortized, but it is a variable rate product. So it's sort of your ideal, from a government standpoint, ideal product.
Well, minus that it's variable versus fixed. My ideal product is amortized fixed.
Ah, got it. Okay, perfect. Yeah. Sorry, what I meant from a government standpoint.
Okay.
The amortized variable.
I understand.
Right. So what I usually see is even well before that, people are refinancing, because a lot of times at that point, having more liquidity becomes more important. They've developed to the point where now they see the value in having liquidity, and their homes have appreciated in value. So then they want access to a little bit more, so they can then make moves that they wouldn't have been able to otherwise.
Last thing I want to cover, because we've been here for a while.
Yeah,
I really appreciate this. Hopefully there's no regret. You're like, worst decision in my life.
It's been great. It's been great.
So we talked about paying off debt and all, and then we also talked about, you mentioned opportunity. Like the person is going to think differently that has access to money that doesn't. And I agree with that. And I would just say, I think one of the big advantages.
So just for what it's worth, when I choose to claim things, right? And I hopefully it comes across this way too, but I feel like it's important to name this too, which is that, Dave Ramsey claims that when you get this, you will be irresponsible with it, period, right? I'm not claiming that when you have it, you will start thinking those thoughts, right?
I appreciate
because like what it gives people the ability to, where otherwise you don't.
And you've even stated in this, like you've told people this is not for you because it could enable bad decision. So I don't think.
Okay.
So we're good. I'm not, and I'm actually gonna I'm going to assume with you that we're talking to a responsible type of person who's
Understood.
an entrepreneur, but
Yep.
that's the disclaimer. Okay.
Yep.
So person A does a 30-year mortgage.
Okay.
Person B does first lien HELOC. Let's say person A has a mortgage at 5%,
Okay.
30-year fixed. Person B, is 8% fair, variable, 8%?
Depending on loan to value, we're anywhere from 6.2 to
Oh,
8.
nice. Okay.
So
Yeah. 8's on the high end.
Yep.
Okay. So we'll say 7%. Okay. So 5
and 7.
7. And so technically speaking, the cash flow payment on if person B had almost no cash built up in their home equity line of credit, the payment at 7% would actually be cheaper because it's interest only than the amortized payment because you're paying principal and interest. Is that true, or is it about the same? I have not fact checked this, so
I haven't either.
Okay.
And so
I don't have my phone on me.
those two, like,
They probably would be somewhat similar, though.
I would say they'd be close.
Okay,
Right?
okay. So let's assume, and guys, you can kill me in the comments here, but let's just assume that the payment is going to be the same month to month.
Okay.
So one, I'm paying off principal and interest. One, I'm just servicing interest.
Mhm.
Okay. Okay, so you have this. Now let's say that, boom, the mortgages are both at $1 million, let's just say. And boom, this person has $1 million fall into their lap.
Okay.
So that they could pay off either mortgage. Well,
Okay.
person A is not going to do that. Person A is going to put that money into a high yield savings account.
Okay.
Person B is going to pay off their mortgage,
Okay.
but they're going to have access to that full $1 million.
Right.
You tracking?
Yep.
Full $1 million. Okay. So now person A is going to have still their 30-year fixed mortgage, $1 million, only earning 3%. Okay. So now we're tracking.
Yep.
Okay. So then now an opportunity comes along. And let's say this opportunity, a 10% opportunity. So it's not a home run, but it's like, here's an opportunity. Person A we still have to factor in a 5% interest to their mortgage.
Sure.
And their money is at 3%. So is it fair to say that their cost is around 2%? I'm taking that what they're earning at 3, what they're paying at 5. I'm not factoring in tax benefits or anything.
Okay.
So the spread over there is a 2% difference, but it's a
cost.
negative 2%.
Got it.
So I'm making the assumption that the opportunity cost of deploying money into another thing is around that 2 or 3%.
Okay.
Versus over here to deploy capital is 8%. Very black and white.
Okay. So if all we're talking about is deploying capital
into an opportunity to invest.
So keep in mind, I'm also paying no interest on the full balance that I
correct.
have, right? Where over here, I'm also paying
Yes.
interest on the full balance.
That's why I
Right.
think it's important to factor in. I think it's important to factor that in.
Right. So I'm paying 5% on the full balance over
Yes.
here and nothing on the full balance.
Yes, but I'm also making 3% on
this,
the,
right?
on the million,
Yep.
and you're essentially making an equivalent 5%.
Yep.
Because of the
I got it. Yeah. So if you're borrowing, let's say you don't pay off the amortized mortgage
Yes.
at 5, you're borrowing essentially at 5% to earn 3%.
yes.
So you're really earning
So if we just
net, you're earning a net.
if we just stop there
You're
over 30 years,
you're paying a net 2% on the amortized
Yes.
mortgage standpoint.
if we just stopped after 30 years, person B would be ahead, the person that did the
Right.
first lien.
Mhm.
Because it's just like if your money's just going to sit there, your money's, it's costing you, it's a negative 2%.
Yeah.
Okay. That's
Yep.
okay. Now, deploying money though is a little bit different because my opportunity cost over here is 3%.
Okay.
So if I take money from a savings account that's earning 3%,
Yep.
it's my cost of controlling that money is 3%. It's
Right.
a wash. I'm no longer able to earn 3%. That's sad, but I'm making 10% over here.
Okay.
You can calculate that. Whereas if my money's in a first lien HELOC, it's the control cost, which I call it in my book.
Okay.
Control cost 8%.
Yep.
And now you look at that same activity, same type of person, over 30 years, if they deploy money into a 10% opportunity, over 30 years is actually going to be a big difference.
Okay.
And so I just wanted to get your perspective on it. There's not a right or wrong, because again, human behavior is way more important than just pure math. But I agree with you. If someone is just going to pay off their 30-year mortgage and they might not get a second lien HELOC and all, like there's going to be in year 10, 15, 20 years, there could be hundreds of thousands of dollars that they don't have access to. But if that person's able to do a second lien HELOC and again, have the mindset, the entrepreneurial mindset of having liquidity, the first lien is a strategy, but I wouldn't even say that it's the most efficient strategy on a way to do that. And I'm just wondering if I'm missing anything. I apologize for those of you at home that are like yelling at me right now, saying, Caleb, could you make that more complicated next time?
So here are my thoughts, right? And maybe this is a common theme of mine, but one strategy that's the best for person A may not be the best strategy for person B, may not be the best strategy for person C. There are a number of different drivers for people. Like, if you are an entrepreneur and you're a straight type A, numbers are the only thing that are going to matter to me, and this is what I'm going to do, then go find the things that help you with that, right? Go implement the strategies that are going to help you accomplish those kind of things, right? If you're the kind of person that wants to go and again, I'm going way off the beaten path, but just to kind of make a point, I like to use extremes when sort of, getting to a concept, but if you're the kind of person who wants to go build, get seed money to be able to build a new tech company, go do that, right? If you're the kind of person that thinks like Caleb, right?
That'd be a disaster.
but point being, right? Then go do what Caleb says makes sense. If you're the kind of person that recognizes or the way that you function and the way that you think aligns with what this is, then maybe this is the best thing for you. And so like I can't, the math itself, obviously I can't dispute, but in terms of like whether or not something is the best.
The only reason I'm bringing that up is I'm literally I'm speaking to myself, because I have looked
you want
myself.
You want me to sell you?
I want you to, dude. I love being sold to. I love being sold to.
Yeah.
But I literally am like, okay, because if there was no such thing as a second lien, totally different story. And then, so that's where, and then if the interest rates were a lot lower, totally different story as well.
Sure.
But for all the things that I mentioned, I would go like, okay, because I'm very entrepreneurially, I'm sitting on enough money to pay off my mortgage tomorrow. So I could literally refinance to a first lien and have no mortgage payment, pay no interest, have access to capital. And yet I still am not doing it because I'm either it's not clicking or maybe I'm just unique, and it actually, for the points I'm making, wouldn't make sense for me to do.
Okay, so I'll attempt.
Okay, thank you. This is going to be a part of the hook.
So so you're understanding and buy into conceptually the First Lien HELOC product and what it can offer. Seems to make sense. There is the rate question, which is an argument, right? Which you understand very well. There is a value that comes with liquidity.
Great.
And so for your standpoint, if the value that comes with that, that liquidity is worth the sacrifice, we'll call it, right? That would come with that.
What do you mean worth the sacrifice?
So for instance,
because I feel like I'm remaining just as liquid over here.
If I could offer you, if someone could offer you a first lien HELOC at a rate that is right where you are,
Yes.
then what you'd be doing is storing your money in a place that is labeled as paying down debt. Whenever you leverage that money again, you're able to use it as a tax write-off.
That's true. That is very true.
It's secured by the home itself, so it's labeled differently, which gives some people
That's
challenges,
a good point.
right?
That's a really good point.
So if there's a scenario where the parameters for your home loan would result in a rate that is lower or close enough to where you are right now, maybe there's a possibility that the higher rate might be worth it, and it may not.
Yeah,
and
that's a good point. I didn't even think about the mortgage interest rate. That's interesting that you can.
So it's weird because with a second lien HELOC, you have to prove that your expenditures are directly related to
The first you
the home.
don't.
No, and I think that it kind of gets grandfathered in because the premise of having to prove that it's directly related, the second lien HELOC interest is related to home renovations, has to do with the fact that I think that the interest that you pay needs to be directly related to the house. Well, the balance that you incur when you pay off a mortgage using a first lien HELOC is by default directly related to the home.
Yeah.
So it's kind of grandfathered in, and it's kind of under the radar in a way.
The strategy that I'm gonna attempt to do, and we'll see if it actually happens, is I believe, don't quote me, I believe the house that we're sitting in right now, I got for 10% down.
Okay.
And so technically, I'm a couple years into this, there should be some equity. So the fact that I've not done this is human behavior. I've not done this. Your case study, exactly.
It's okay.
But like, let's say, this is a good, maybe you can hook me up.
So here's the thing. So my question would be, if it's such a great idea, why haven't you done it already?
Exactly. That's going to be my takeaway. It's probably because I'm not.
It's not your focus. It's okay. Yeah,
but it's going against everything because you build the well before you need the water. So, so I don't know how second liens, like how low you can go, but let's just say I have 5%, 15% equity.
Fair enough. Yeah.
Okay, I'm just making this up, and then I could get a really small second lien.
Yep.
And then if you look at my portfolio, you'd be amazed by how liquid I am in a lot of different areas because I value liquidity. And so you could make the argument that, if I did that perfectly, I could almost remain the same. But the point that I didn't do it is the point that exactly you're making is like, I'm more sophisticated than maybe the average person.
Fair ove.
And yet I haven't done this yet. So I think that's your point to a T, whereas like, okay, if this was so valuable, why haven't I done this?
Another motivational theory.
Yes.
Right?
I didn't know I was going to get so many motivated.
The thing is this.
I feel like I should be more motivated though.
I really enjoy this kind of stuff too, just because it helps me, understand human behavior. There's a guy named Thaler. He got the I want to say Nobel Prize in economics in 2017. He spent a lot of his life's work focusing on what he calls the planner versus the doer. And the planner is the person, you have both of these inside of you, right? And the planner is the one that creates the spreadsheets. The planner is the one that figures out the plan and the math and the way to accomplish certain goals.
Yep.
And that's what a lot of people in the financial sector, focus on, is like, here's the plan. I'm going to commit to the plan. I'm going to do it. Right.
Yes.
That's your first week in January, right? When you commit to your new goals. Right. And then you've got the doer, and the doer is the guy that shows up at 7:00 after a really long day and has to then follow through with what the planner set. Right.
Yes.
And it's not that you don't want to be the planner anymore. It's not that you don't want to follow through. It's just that things get in the way, right? So that could be part of it. Another thing I think could be that for you, if doing that truly was your priority, you'd actually be doing it.
Yeah.
Right. And so we can talk about theory and best practice and in different niches of financial and family and faith and all those kind of things, right? But your individual goals of what you want to accomplish, what you do should align with those things. And so if you're not doing it, it's not because you don't think it's good.
Yes.
I think it's just because
There's more friction.
There's more friction, and there are other things maybe that you've identified as being the priority, because time is a resource when we have limited.
I think that is a perfect example of why math is not always reality. Because if it was, we would be in totally different. Like, math and money are different,
right?
And so I'm gonna try to land the plane. If there's anything else that I missed, I apologize, but we've gone for a while. Where I believe first lien HELOCs fit are for two types of people. Person number one that is motivated to pay off their debt, their mortgage. And if you're someone that's motivated to pay off your mortgage and you're aggressively paying it off, or you want to aggressively pay it off, I personally believe it's irresponsible you to do that in a 30 or a 15. And you should do one of these, and if you're set on paying the bank each month, whether I think it's a good idea or not, a first lien HELOC would be a way better way to go about it, because it gives you optionality if something happens in the next 10, 15, 5 years. Okay, so that's number one. Number two would be someone that buys into the behavior thing, which is, I think, the strongest argument, period, is to say, listen, we could do all these spreadsheets, but the reality is I can do one loan. It creates the least amount of friction. It creates the most amount of momentum. I mean, in sports, explain momentum to me, because it's real, but it doesn't, like, how do you
just watch scores in basketball in more than almost anything.
So
they swing
and
like
this
crazy.
is where Dave Ramsey has it going on, because he gets people fired up. And I would say that there's something as it relates to this that, I could hit someone over the head with math and spreadsheets and all, but people don't have a math problem. They have so many other issues.
Right.
And if you can give someone a spark of motivation, hope, insight, so you could disagree. There might be more, but like for me, if you buy into the behavior, if you're listening to Anthony and you're like, I get it, it makes sense, then don't hit me with math. Just tell me, like, hey, it's almost the same. It might be a little less attractive, but the momentum and benefits I'm getting by having this product, amazing. And if you're someone that's like, Caleb, I don't care at all what you say. I want to pay off my debt and I'm not going to have a side account, blah, blah, blah. I'm going to pay the bank. First lien HELOC. Those would be the two areas. And that's a big group of people.
It is.
Huge group of people.
Well, and there are a lot of people within that sector. I would argue probably from a financial discipline standpoint, we're talking about in terms of who it would not hurt. Probably 15% of all homeowners.
Yeah, which is a lot.
Which is a lot of people, and then you have those particular qualities within that subsection. I would add to it, which is people who are sitting in good equity positions who want to leverage, who don't have
a second lien. Like, I would personally do the second lien because you have optionality with the fix versus changing. I guess it depends on.
So if you're going to be someone who's going to refinance into a new second lien every time you pay down the balance, right? Then that makes sense, right? But that adds friction. It adds work.
Yeah,
it adds,
that's true.
Those kind of actions.
I just struggle. Here's what I struggle with. We didn't even mention this until now. Is refinancing low fixed rates into first. I struggle with that. I still stand by what I said over here with the two things, but I would struggle like refinancing a 4% into a.
And that's not an uncommon thing for us to face. And when that's the case, then they don't get the loan. And so, I mean, to me, it's that black and white. It's like, if this isn't for you, then don't get it. And that's okay, right? Because
it's a tool.
It's a tool. Here's how it works. I'm not here. I mean, it's funny. Sales manager, but I'm not
a sales manager. That's not a sales guy.
Right,
I feel like they should get a new sales manager.
I kind of,
you're an educator.
I keep thinking that, but the sale happens when someone learns about this and they buy into it and they want it.
Yeah.
Right. And so the sale doesn't happen because we hire consultants to come teach us how to weasel our way into getting a sale. That's not it at all. We're actually more gatekeepers than anything, because people that are excited about this that don't quite get the math, we have to be like, listen, this
Not how it
doesn't
works.
work.
Yeah.
Like, or hey, look, it's going to take you 15 years with your cash flow to pay this off. This is not safe for you.
Yes.
So we have, I would argue, a much different approach, because during our discovery calls, I guess you can call it sales calls, but it's more of a discovery call. Our job is to really filter people out.
Yeah, I think that's great.
If that makes sense. And
Yeah, makes a ton of sense.
so like I said, the sales job that I have, by definition, is different. I'll kind of go back to at the beginning when I said I'm not a good salesman. Like, I wouldn't flourish in a lot of sales jobs.
Yeah.
Just because what's required for those particular scenarios, you have to apply the sale to every single person you talk with. And it's just opposite for us, And so it's more of like, is there a way that this person is going to benefit from this, or is this going to be dangerous for them? So
cool. Anthony, we'll include whatever you are willing to include down below, like your email,
I love it.
website. And I would say, if you have questions, if you have questions just about your own situation, if you want Anthony to take a look at your current situation, I'm sure you'd be willing to do that.
So what we'll do, I've got a couple links that I'll share with you guys. One is going to be, we do have, we work hand in hand with FirstLienHELOC.com.
Cool.
And so it's a free educational resource that people can go to and learn about First-Lien HELOCs and how it works. It's got a calculator, so I'll include the link to the calculator. There's a webinar as well that teaches the concept. It'll pretty much be everything we talked about today, but it may be a good refresher. I'd also advise, that's one resource, but there are a lot of resources online to learn about this, and a lot of different people that teach the same thing in a different way. Yeah. And I think it's a really great thing to do. Obviously, that, again, it goes against the whole like sales idea, right? Where talk to me only, but through that website, I can, I'll also give you another link that will allow for you to book a call with the loan officers on my team as well. And so the calls usually are, there are 4 parts to it. What are your goals? Do you understand the strategy? How can we help you, make sure that you have a comprehensive understanding of that? We run the numbers to make sure that it is going to be a good fit with the current cash flow. So you're going to have your income and expenses, and, current balance in the house. And then we answer the question of, should this person even get it first, before we even ever talk about the product. So the last thing we do is sort of spell out the product in terms of how it works, and, talk about costs and rates and the specifics in terms of the guidelines, because the second question we have to answer is, can the person even qualify for the loan? So we actually spend the majority of the call about the qualitative aspects of this, and whether or not this is a good fit for someone, or whether actually it's more about like, are you a good fit for this? Yeah. And then once we sort of determine that that's the case, then it's like, okay, now let's shift to, here's the product. Do you want what we have? So that's when the sales side of it comes in, but only after we have that first part of it. So
cool. Anthony, thank you so much.
This has been great, Caleb. Thank you. Appreciate you.